Hey, what's going on, everyone? This is Nick Saylor with Saylor Tax and Accounting. Today I'm making a video talking about what a business write-off is, what business expenses are, and how they reduce your taxable income, and they aren't just free money. It's a difficult concept to grasp if taxes are a new thing to you, so we're going to talk about it, and I've got a good video to show you to kick things off until we actually explain. So this is from the show Schitt's Creek. Here we go.
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people. What? Why are we having this conversation?
So if I need...
Okay.
David, a write-off is a business expense used to reduce your taxable income.
Okay, well then, why isn't it called a tax write-off?
It is! It is! You can't just buy things for yourself and write them off.
Well, then I'll return some things.
So I think this is hilarious. The only reason I wasn't dying laughing is because I watched this 10 times prepping for this. But basically the idea is, people say they're going to write something off. You think it's free money, but it's really not. So this whole video we're going to talk about, what is a write-off? How does it lower your taxes? How much does it lower your taxes? And is it worth, spending your money on these business expenses for the tax savings, right? So we're going to look at that a little bit. Now, fundamental to understand this is what gross income is, what your net income is, taxable income, and then how you're taxed. Okay, so we're gonna look at this here. So on the screen you see gross income in a business. Let's say it's $80,000. Okay, now you're not taxed on this gross income because you have business expenses. So if your tax rate was 20% and you only got taxed on the gross income, if you got taxed on the full gross income, 20% of $80,000 is $16,000. So you would have $16,000 in taxes. It wouldn't be this high, but that's just an example. Okay, but with write-offs, which are business expenses, these lower your taxable business income. So if you have $15,000 of business write-offs that come from advertising, contractor, software, and computers, $5,000 each, that's $15,000 total. We get down to $65,000 in taxable business income. Now, instead of being taxed the full $80,000, you're taxed at $65,000. So again, at a 20% tax rate, this would be $13,000 you would pay in taxes instead of $16,000. So basically, those $15,000 you spend in write-offs would save you $3,000 in taxes. Okay, so it's not a free $15,000. It's you spend $15,000 in qualified business expenses, and then because of that, you save $3,000. So you get $15,000 of stuff basically for $12,000. Another way to look at it is, I'm using that 20% rate. So you could look at it this way, I want to buy this thing for $10,000 and I know I'm in the 20% top rate bracket. What's 20% of $10,000? It's $2,000. $2,000 is how much I am saving on taxes by buying this thing. Okay. So now, once you understand that, just spending every dollar your business makes might not be worth it. Now, I love tax strategy and I love helping people reduce their taxes. That's what I'm interested in. But some people go about this all wrong. They think, well, how can I pay no taxes at all? Well, the way you pay no taxes at all is you have your $80,000 of gross income and you spend $80,000 on business expenses. So then you're left with $0 of taxable income. So that's great because you owe no taxes, but guess what else you have nothing is profit. All the money's gone. You spent it on crap that you might not have needed. So we have to think of it that way as okay, it's good to save taxes, but will this money that I'm spending to save taxes benefit me more than what I'm saving on taxes? If you're going to buy, a piece of software or something for 10 grand, is that going to make you 10 grand or more over time? Or is it just I didn't really need that. It's a better tool to use that doesn't make me any money. We got to think about the utility of what we're purchasing. All right, now the next thing we're going to do is pivot to a tax plan that I did with a client. This was just a tiny piece of it, a spreadsheet that I built to basically show them that what different things that they do, what those payments will save them on taxes, right? So this client was in basically the 24% marginal tax rate. They're in a state with no income tax. So that's really all we needed to worry about was the 24%. Based on their estimated tax payments and everything, they were going to owe about $8,000 at tax time next year. And this is an S corporation, so this factors things in a little bit. So we're not really going to be talking about self-employment taxes like you would with a Schedule C person. Big difference there. So one thing that this client was interested in is they've got some younger children, and they've heard, I can pay my children to be for modeling, to be in my advertisements, or you can pay them to shred paper. I'm not here to talk about like how legit that stuff is. It's not my favorite thing to deal with, but the IRS does say if you can pay your children a fair wage to do real work in your business, it's a business expense. So this is something I was helping them understand. So we wanted to think about, okay, so how I wanted to show it to them was, okay, you can pay your children. We can decide something and agree on something that we think is reasonable. But let's see how much that's even going to save us on taxes before we go down that huge rabbit hole. So the kids really wouldn't be doing too much. And if you have an S corporation, you also have to set up a sole proprietorship LLC, basically. So there's some expenses there and just some effort and headache. So we thought they had 3 kids. What if they each made $1,000 in the year, right? So we'd put in $3,000. Now, what we'd expect is that you would save about 24% of that $3,000. But one thing you also have to think about is this business expense leads to less business income, which leads to a smaller qualified business income deduction. So instead of 24%, it might be more like 20% in tax savings. So basically, if we set everything up, the family management company issued W-2s and did payroll to these kids, all that effort to pay them $3,000 in a tax write-off, it would save us $576 in the end. Plus, this $3,000 that was in our pocket before, us as the parents, is not in our pockets anymore. It's distributed out to our kids, and we can't take it. We can't pay our kids and then take the money. That's basically tax fraud, I would say. So basically, their choice was, okay, do you want to take $3,000 from the business, put it in your kids' bank accounts, and leave it there? And in doing so, you'll save $576 in taxes. Doesn't sound so good when you put it that way, right? It's cool because it keeps wealth in the family. But when you're out $3,000 to save less than $600, it's not as attractive once you put it that way. So it's important. Now, say they needed a new piece of equipment that was crucial to the business and it was wearing out. In the next year, we could decide, okay, do we want to do that in 2024 or wait till 2025? Let's say it's 25. Well, let's just say it's $10,000, right? Now this is the same deal, right? $10,000 on this piece of equipment. We could use Section 179 expense to write it off. But again, you're paying $10,000, and the tax savings you're getting in doing that is about $1,900. So you get something worth $10,000, this piece of equipment, for about $8,100 net. So it's not making you money to spend that money, but if you need to spend it anyway in the normal course of business to turn a profit, it's great. You can write it off and save like 19%, right? And this is a pretty basic example. There's people higher in higher tax brackets, like up into the 37% when you're making a lot of money, and then 10% state. So it might be double the tax savings, right? But a lot of times people kind of land in this. Accountable plan, we don't need to talk about that right now. This was an S Corp owner who could have also reduced their salary a little bit for the year just based on some different things that played out. We're not going to talk about that now because this was related to lowering payroll taxes. One caveat to this, when you think about one spouse owning a business and another spouse just having like a W-2 job, is that the husband, this is the woman owns this business, but the husband had a 401k at their work. So they could have contributed $5,000 and they would have actually got that full 24% savings. It wouldn't have been reduced by a qualified business income deduction because this is an expense outside of the business, right? So like to make it like apples to apples, right? $5,000 being spent in the business saves $960, but $5,000 being contributed by the husband to the 401k would save that full 24% or $12,000, because if you look at the formulas here, this just, is the marginal tax rate, but this, we have to do that extra calculation for the qualified business income deduction. So in the end, you can see that like the total decreases add up here, and then you can see, okay, well, if the client decided they want to pull these levers, which they didn't want to do, to pay the children anymore, it's not worth it. They wanted to buy the equipment, they wanted to set up an accountable plan. Now with these new business deductions, they'll probably only owe about $4,200 at the end of the tax year instead of $8,000. And then with that, we can do things like pay estimated taxes or add more tax withholdings through the S Corp W-2, or increase the husband's W-4 withholdings at his W-2 job. There's all sorts of things you can do to get this to zero, but this is just to show like how can we get the true tax liability down before we start making payments. That's all I've got for you today. I hope this helped kind of frame what a business expense and a tax write-off is, so that we can all understand that it's not about just spending all the money because we want something left. We want profits, but we do want to take advantage of lowering taxable income in a smart way whenever we can. Thanks so much for watching, and we'll see you next time.